Hello, fellow Rebel Capitalists. Hope you're well. So we've got the new CPI data out, and it shocks the market. Does this mean we are headed toward the 1970s? Stagflation, that's what I read everywhere on Twitter and in the mainstream media online over the past few weeks. Stagflation, stagflation, stagflation. So is it here? Is it at the doorstep? Let's get right over to CNBC and check out what the data says, and let's try to think it through. So CNBC, inflation rate eases to 2.4% in March, lower than expected. Core at a 4-year low. Now, the disclaimer that I always give in these videos on CPI is I know this doesn't me. I know your expenses are going up a lot more than I get it. And I know this understates inflation. But the reason I like to use the CPI or look at it is because the market trades on it. Obviously, the Fed looks at it. So it's going to play into Fed policy. And it's, I think, a good proxy for the trend. I don't know that that the specific number is accurate, but I think the trend is reflected well in just this headline number. So let's get into it. Now, as you guys know from watching my videos, I wasn't so much concerned with the year over year. I was much more focused on month over month. That's what I really wanted to see with this report. And fortunately, they go into that right here in this article. So key talking points. The consumer price index fell a seasonally adjusted 0.1% in March, putting the 12-month inflation rate at 2.4, down from 2.8 in February. So down 40.4%, excuse me. Excluding food and energy. Whoa. So this is probably the biggest news of the day right here, Josh. Did you see this? So they're saying excluding food and energy. Where's volatile? What? Have they completely lost their minds? The mainstream media is talking about food and energy without prefacing with volatile food and energy. Oh, it's volatile. Whoa. I think in all my 5 years of doing this, I think this might be the first time I've ever seen them mention food and energy as it pertains to core CPI or the CPI in general without saying volatile. Wow. That is the big news of the day. That could be the big news of 2025 right there. All right. So-called core inflation ran at 2.8% annualized, or the annual rate, excuse me, having increased 0.1 for the month. That was the lowest rate for core inflation since March of 2021. This really comes as no surprise because, and we'll get into this in a moment, when you have an economic contraction, it's not a thing to have inflation accelerate. That doesn't happen in the United States. Now, maybe it will in the future, but if we look at past even in the 1970s, when you have a recession, especially once you start seeing the unemployment rate increase or skyrocket, go straight up, you have disinflation. Now, you could still have high levels of inflation, but the inflation rate goes down from wherever it was at the beginning of the recession or at its high point. And we'll get into a chart that shows exactly what I'm talking about. But that's why I always say that you either have to, if you believe that the inflation rate is going to accelerate, you cannot believe we're going to a recession. Those two things do not coexist. So either you have to believe we are going into a recession, or you can believe that inflation is going to accelerate. But you can't really blend the two. It doesn't work. And that's what I see everybody doing online. Oh my gosh, we're going to go into a recession where the inflation rate is going to go from 4 to 6 to 8 to 9. And then the Fed's going to have to come in there and buy treasuries because the treasury rate's going to be going up to 10%, and they're going to have to monetize the debt and do QE and all these things. And maybe I'm not saying they won't have to do that. I'm not saying they won't have to do QE. But it's not going to be because the inflation rate is completely getting out of hand during the recession. Now, after the recession, then it's a whole new ballgame. But I'm just talking about over the next, call it 6 months or 12 months, assuming that we have an economic contraction. Okay, getting back to it. The Consumer Price Index, broad measure of goods, services across United States, fell a seasonally adjusted 0.1. So let's look at a chart. Let's just go straight to the chart because that pretty much tells you everything you need to know. And then we'll kind of, where is the chart? Why is this chart not coming up? You got to be kidding me. They've got two charts here. Let me see if I can refresh. The beauty of live streams. There we go. Let's just go to the chart, then we'll kind of go back to the details. And no, thank you for your pop-up. So we got 2.4, and like they're saying, this is the lowest level. Looks like going back to, no, we were at 2.4 back in September 2024, but then you got to go all the way back to basically the beginning of 2021. And then I think they were talking about the core inflation rate, less volatile food and energy. That's what they were talking about, is at the lowest level going back to the beginning of 2021. I'm just kind of eyeballing it here. So now let's go over to what I think is far more important, and it's the month over month. And you can see we're negative here. And actually, let's go over to Zero Hedge, because I like to look at Zero Hedge, especially in the case of the CPI, because they're always going to try to spin it to where we're going into hyperinflation. And I love the guys over at Zero Hedge. They're great. And so this isn't, I'm not being critical of them, but I know that they're going to put, if they can, they're going to put an inflationary spin on it. So because I want to look at both sides of the argument for sure. By the way, Dow falls 1,000 points. This should be a bumpy one today as well. We're going to do a video on that obviously later on today. But let's go over to Zero Hedge. So March U.S. consumer prices fall most in 5 years. Oh, you know what they could do? They could spin it to where this is Trump winning. Because what I've noticed from Zero Hedge is they have kind of like a hierarchy. And their priority, as far as I can tell, their number one priority is pro-Trump. And then hyperinflation is actually below that. And then I think bearishness is just below that one. So if they have to choose between being bearish and pro-Trump, they're going to choose to be pro-Trump. And so I think that's kind of their MO. Maybe I'm wrong. That's just kind of what I've noticed. So maybe they're going to say, okay, yes, prices are coming down. We're not going into hyperinflation, but it's because Trump is winning and playing 5D chess. We'll have to see. The normally crucial consumer price index measure of inflation. Okay, we talked about that. Oh, wait a minute here. I think this is where they do it. March is likely to take a back seat to the next red flashing headline on tariff on everyone's Bloomberg Terminal. Oh, okay. Yep, I totally agree with that. That's for sure. This is probably going to be swept under the rug like kind of a nothing burger, because everyone's just watching the Six Flags ride that is the S&P 500 right now. But they say, having dipped lower than the previous month, expectations were for both headline and core measures to continue trending lower year over year, and they were. Yeah, but this was lower than expectations. This shocked the market. The market was not expecting this level of decline. So they say headline CPI fell 0.1 month over month. We got that, which dragged year over year down, matching the September lows. Now, okay, so let's blow up this chart because see, this is what they do sometimes is they just wildly exaggerate. Like this could be a negative 0.1 right here month over month, and like this one could be a negative 0.1, but they just don't want you to notice that one because they want you to see, like, just visually assume that this is the worst thing since the cerveza sickness. I don't know, Josh, did it say that on the let me go back to CNBC here real quick. Okay, so it was lower. Or was it? Right here we have a negative 0.1, and then we have a negative 0.1. CNBC is doing the same thing here. What? Am I not seeing this right? Josh, can you see this?
Yeah, we can.
That turquoise bar is lower than that turquoise bar, isn't it? Or am I just going blind?
Yeah, it's definitely.
But yet they're both negative 0.1%. Maybe there's rounding. I don't know. I'm trying to maybe they're like rounding up here and they're rounding down here. So maybe this is a negative 1.3 and this is a negative 0.9 or 0.8. I don't know. I'm just trying to spitball it here, giving them the benefit of the doubt. But let's get back to the Zero Hedge article. So then they break down okay, so CPI. Okay, so then you've got energy. So what they're showing here, and this is really good, they're breaking it down. It has a lot to do with energy. And this is another reason why in a recession, when you have demand destruction, you have aggregate demand go down, what usually happens to oil prices? They go down as well. And that has a big impact on the CPI and overall consumer prices. And therefore, this is why you tend to see the disinflationary impacts of economic contraction. It's one of the many reasons. I think a lot of it has to do with risk and money supply as well, because the banks are the ones that really produce the money supply, as you guys know. And so if the banks aren't lending, then there's going to be more people paying off loans and more people taking out loans. And therefore, you have money supply either going down or flattening out. And you have the velocity of money slowing at the same time. And then that just puts further downward pressure on oil because there's kind of a shortage, if you will, of dollars that are actually circulating. Not necessarily a shortage of dollars, but shortage of dollars circulating. That's a very important distinction. So anyway, getting back to this here. This is what is this? This is the CPI Urban Consumers Core. Okay, so now they're breaking it down even further. Okay, so now they've got their summary. Yeah, they're talking about energy fell 2.4% in March as a 6.3% decline. And keep in mind, guys, this is March. Okay, so this is interesting. Let's go over to the price of oil right now and just use that as a proxy of overall energy. And let's see what the decline was in March. And let's think about what the possible decline is for April. And then what that will have and what impact that will have on the next CPI print. And then what impact that will have on the Fed's decision as to whether or not to cut rates. So let's shoot over to oil. Oh my gosh. Down into the 50s again. Oh, geez. Wow. down into the 50s again. All right, let's not get sidetracked, George. Stay focused here. So let's go to the last 3 months. Okay, so let's look at what happened in March. So at the beginning of March, we were right, where were we here? We were right around, call it 69. And then so right around 69. And then at the end of March, 69, maybe even higher. Okay. So, I mean, maybe what they're referring to is kind of this dip down that for the majority of the month, the prices were lower. But I mean, even at that rate, you went from 69 down to 66. I mean, what happens? Look at this move. What happens when that's priced into the CPI? So if oil stays in the 50s, I would not be surprised. I mean, I'm improving here. I haven't had time to really think this through because it's the first time I'm seeing this as well. But I would not be surprised if we were at 2%. Because last month we were at 2.8%. Let me just make sure that let me fact check myself here as we're going through this. Because last month we were at 2.8, if I'm not mistaken here. So we've got 2.4. Yep, down from 2.8. So we are down 0.4%. And if they're saying that the main reason we were down 0.4% is because energy prices and oil went from 69, let's just say down to 66 for the majority of the month. I mean, what the hell is the CPI going to be if we stay in the 50s for the majority of April? So then the Fed is really going to be backed into a corner. They are really going to be, I mean, think about this. If we get the inflation rate down to 2 or 1.9 or 1.8 in the next reading, what does the Fed do? Like, how on earth can they argue for keeping interest rates where they are? Because then that would completely contradict everything they said from 2010 to 2020. Remember, we got to get inflation up to 2%. We got to get inflation up to 2%, up to 2%. We got a 2% target. I mean, you guys have heard this for a decade that we got to get inflation up to 2%. Well, they got it up to 9.1. Congrats. We've been fighting inflation and worried about tariffs and all these things, creating inflation. What do they do? What do they do if they get a 1.8 print? I don't even know how they would spin that, assuming that they would want to lower by only 25 or maybe not lower, continue to pause. I have no idea how they would spin that. I guess they could say, well, yeah, the CPI is at 1.8 right now, and that is lower than our target, but we're going to go ahead and pause just because we're worried that the inflation will come in the future due to the tariffs. I don't know. This is going to be, I tell you what, in these times of stress, whether it's the cerveza sickness, whether it's Ukraine, Russia, whether it's tariffs, you see mental gymnastics that you did not think were possible. I know I've been seeing that over the last week to a degree to which has blown my mind. the mental gymnastics. Whoo, boy, I tell you what, we would be winning. If this was the Olympics of mental gymnastics, we would win every single gold medal. Oh boy. So we'll have to see what mental gymnastics Jerome Powell pulls out, because I think there's a pretty low probability that oil stays above 60. I mean, think about it. Yesterday, we had the relief rally of all relief rallies. I mean, let's not forget NASDAQ up 12% in one day. In one day. So if we were having all of this demand destruction or expectations for demand destruction because of the tariffs, now all of a sudden we see that Trump is willing to get rid of the tariffs as fast as he implemented them. He's willing to take them back just as fast, with the exclusion of China. So my point there is, if the threat of tariffs dropped the oil price, if that's all there was here, if it wasn't really the fundamentals of the underlying economy, then why is it that when the tariffs go down, oil is still trading in the 50s? It's a rhetorical question. And so I don't see how the underlying fundamentals of the economy change significantly throughout the rest of April. And therefore, I would not be surprised, like I said, if we're trading in the 50s throughout. And you would have to assume that that takes us real close to 2, if not under. This is going to get really, really interesting. Let's get back to the Zero Hedge article. So let's pick it up right where we left off. Energy CPI fell 2.4% in March, as a 6.3% decline in the index for gasoline more than offset. Okay, I got it. So they're focused on gasoline. We were looking at oil as a proxy. Okay. Gasoline more than offset increases in the indexes for electricity and natural gas. Food CPI rose 0.4 in March, as the food at home index increased 0.5, and the food away from home 0.4. Okay, got it. So details for core. We know the headline, or we know what the numbers were. The indexes that increased over the month included personal care, medical care, education, apparel, new vehicles. Index for airlines, motor vehicle insurance, used car, trucks, recreation were among the major indexes that decreased in March. Shelter, that's a biggie, increased 0.2. Owner equivalent rent was 0. So, and the index for rent, this makes a lot of sense, because the Fed's measurement for housing, it always lags. It always lags. And as most of you know, I'm good buddies with Kenny McElroy, and he runs, $2 billion worth of multifamily properties. Last time I checked, 10,000 doors for apartments. And he's been telling me that rents are definitely soft. I don't know if he's started to decrease them yet. Josh, do you know? I mean, I know you talk to Kenny almost every day. Is he at the point where he started to decrease rents in some of his markets?
I'm not sure.
The yield.
Okay. All right, personal care. Okay, bam, 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 bam. It's basically a summary of what we just read. Okay, now they're looking at year-over-year increases. We know that. Month-over-month increases. I want month-over-month decreases. Specifics here, Zero Hedge. All right, they're not going to give me that because of what we were saying at the beginning of the video. Well, the good news here, guys, is if this continues, and who knows if it will, right? There's only probabilities, there's no certainties. If this continues, and if you're able to keep your job, if we do go into recession, well, we should see some lower prices. Prices will never go back to where they were in 2019, I can assure you. And overall, I doubt that we get deflation, which would be, the basket of goods actually decreasing overall. But maybe. But I guess the good news is the rate of inflation is decreasing. And so for those people who have a job, for those people who have security in their income, that's definitely going to benefit them. That's great news. If we could just take this in isolation, this is great news for the average Joe and Jane. The problem is usually this doesn't come in isolation. This comes with a substantial spike in the unemployment rate. Okay, Josh, let's go ahead and take some questions over at Rumble. So for those of you who are on YouTube watching this, for those of you on Twitter watching this, go ahead and shoot over to Rumble right now. In fact, Josh, let's take the advice of that person yesterday and go ahead and put a link to in the chat right here. Can you please do that? Let's see. Josh is checking his Tinder account here. Let me see if I can do that on my end. Let's see. Okay, Josh has got it in there. Great. So guys, just go ahead and click this link in the chat and you can shoot over to Rumble right now. Ask a question. We'll be over there for about 10, 15 minutes. So for those of you on YouTube, on Twitter, as always, make sure that you are standing up for freedom, liberty, free market capitalism. We'll see you in the next video, and we'll see you over at Rumble in about 30 seconds.